What's up, everybody? My name is Carlos. I'm a stock market investor and I'm a long-term dividend investor. And today I just got a quick video, kind of lay out a little bit of foundation to these new investors out here. It's an exciting time, but it can also be very intimidating. So I just got some vocabulary I want to run through, kind of show you the basics, or hopefully give you a well-started foundation. If you're already well-seasoned in investing, I guarantee you probably already know these terms. These are more aimed towards the beginners. First of all, straight, flat basic. What's a stock? A stock is a capital raised by a business or corporation through the issue of subscriptions and shares. So, these big corporations, they make a lot of money, but on top of that, they want to expand. So instead of accumulating a whole bunch of debt, they sell out shares of their company to kind of help themselves grow. As well, something that I didn't really know when I first got into investing. I've heard the word, but I never knew that, what it was all about is dividends. And as a long-term dividend investor, this is like kind of the root to everything. This is what helps you build substantial growth, what helps you build compound interest through dividends. Pretty much what a dividend is for owning a share for a period of time till the X dividend date, the company will actually pay you to hold that share. They either pay quarterly or some companies even pay monthly. And not every company pays out a dividend, but that doesn't mean it's a bad company. Usually what that means is that instead of paying that out, they just reinvest more money within their company and grow themselves just like that. And typically what you want to go for is you want to go for your blue chip stocks, because down in the long run, those are the companies that are going to stick out the most. And pretty much what a blue chip stock is, it's a well-established company with a good reputation and quality that, they've been around for years. They have huge market caps, so chances and the likelihood of them failing is very slim to none, if anything. It's just a safe place to park your money, to where your dividend can help you grow, and eventually when you retire, that company should still be around and pay you that dividend. And one thing that helped me feel real secure as a dividend investor is that you have a class of stocks called dividend aristocrats. And these are stock companies that have been around paying a consistent dividend, and not just paying it consistently, but also raising that dividend for 25 years. And that's a long time. It's weathered recessions, it's weathered pandemics, it's gone through the most, it's weathered wars, and just goes to show that no matter what happens, they're well established and they're not going to stop paying you. And not just dividend aristocrats, you also have dividend kings that have consistently paid, and not just paid, but raised their dividend. And this is all on top of your growth. But they've raised their dividend and paid it out for 50 years. And there's only 29 companies that are classified to be dividend kings. There's a couple companies out there that are closer to the 45 and 49 year mark, but 50 years is a long time to be paying out and raising. It just goes to show it's safe and secure. Another thing, I feel everybody kind of hears this before they even get into the stock market. They hear about your ETFs, your index funds, and your mutual funds. Pretty much what those are, they're big groups, or pretty much one company that invests your money for you and spreads it out across multiple stocks. It helps you diversify, and they're really helpful tools. Specifically, I like going with your index funds and ETFs just because they have lower fees, management fees, and you barely even notice it. But as to your mutual funds, they could have more growth, they could not. There's nothing really that solidifies that. It's just they're managed manually by an individual. Unlike your ETFs and your index funds, those they're managed automatically, and that's why they have lower overhead to hold and buy into. If you haven't heard of that, you probably heard of the S&P 500. Pretty much it's a stock market index of the 500 most best performing companies, and they have to have certain qualifications to kind of get in there. They either need they need an $8.2 billion market cap, and on top of that, they've had to have had 4 consecutive positive quarters of gains and growth to kind of get them in there and to be put into the S&P 500. It's an index that everyone looks at and everyone's well aware about, and it's good to go in there, pick some of the stocks you really like, and you could never go wrong with a majority of those stocks in the S&P 500. I always get asked all the time, how do I tell that a company is a solid investment, if it's overvalued at all? And one way that I look at these companies is that I look at the PE ratio. Typically, a good PE ratio for a company is roughly around 60. That's your price per earnings, and that alone tells you that they can actually afford to pay out that dividend. It compares their market price as well as their earnings per share, and anything between 60 is a solid investment. Right now, because of COVID, is pretty high. Something at 100 it's worrisome, but it's not going to concern me enough to sell it, or anything above like 120. That should have you a little more worrisome. I should just tell you that they're probably going to cut their dividends soon. The company's not going to collapse or anything like that, or it could. You really genuinely don't know with the stock market, but chances are most likely what's going to happen first is they're going to cut their dividend. And the reason why I like dividends so much is because you can't lie with the dividend. Either they're profitable and they can afford to pay it, or they're going to have to cut their dividend and cut their costs, because it wouldn't be smart at all to continue to pay something that you can't afford, especially as a corporation. And a big technique that I like when I invest, is diversification. I'm so big on it. I see other YouTubers out there, they have 100+ stocks and all that stuff, and that's, to me, it's not overwhelming, but at first it was. I would think, how can you keep track of all that? It doesn't make sense. But there's various amount of tools out there that can actually help you succeed in that. You have Excel spreadsheets. Personally, I love Simply Safe Dividends. That's how I go. I can enter in my whole portfolio, keep track of everything, sort it out. And if I have to look deeper into the company, I'll pull up their balance sheets. I'll look at their debt, make sure they're not drowning themselves out. And me personally, I have roughly around 43 holdings. It's manageable for me. Eventually I would like more, but I don't think I would ever want to go over 50. I would just kind of check everything out. And even if I do go over 50, it'll probably be momentarily. Even though I'm a long-term investor, there's some stocks out there because of COVID that I wouldn't mind selling off to rebalance my sheet and put them into more solid investments, because I'm thinking about the long term. Yeah, a company's probably paying a good dividend now, but if I can't actually visualize them to make it by the time I want to retire, why would I want to invest in them? It just doesn't make sense. I want security. And that's why I love dividend investing so much. To me, it's safe, secured, and I haven't done it for a whole long time. I'm not gonna lie, I'm fairly new, less than a year, but it's been profitable for me, and I've made great gains. And due to COVID, that's why I made such substantial growth so fast. But even after that, you're gonna average out a 7% return after adjusted for inflation, and that's way better than any savings account that you can get out here. So I just want to make this video to help people out, kind of take the edge off of everything, help you build a foundation, and thank you for watching.